Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching IndianOpen on a day when the markets promise that they will start off in the green because the world markets are just so supportive. Let's go to the headlines first though. China's manufacturing PMI gains the most in 7 years to come in at 50.5 in March, easing one of the biggest worries on global growth outlook. The government front-loads its borrowing calendar in the new financial year, will raise 4.42 lakh crores from the market. India's fiscal deficit continued to widen in February, coming in at 134% of the target, but the government says it's confident of meeting the 3.4% target for the whole year. And Congress President Rahul Gandhi will also contest from Wayanad in Kerala, in addition to the earlier seat. Well, and you can give whatever color you want to that, but that is a fact. 2 seats from where Rahul Gandhi is going to contest. Let's take a look at the trade setup for the day, though. The world markets are a happy place. The US markets ended on a very strong footing. The trade optimism led to the Dow Jones notching up some serious gains, and the S&P 500 has had the best start to a year since 1998. We were all talking about how strong 2018 has been for the US. Boy, the first quarter of 2019 stronger than what we'd seen in 2018 as well. So while everybody in mid-2018 was talking about worries about what will happen to the markets because of the base effect, because of the US Fed coming down and tapering, nothing has happened. It's the best start to the year since 1998. And look at that. Look at the statistic. It's not just equities, by the way, and not just global equities. S&P 500 YTD return 13%, best since 1998. Crude had a very strong uptick in the first quarter, best quarter since 2002. High yield credit in the US, 2003. Emerging market dollar bonds, best quarter since 2012. Investment grade credit, best quarter since 1995. It's been a very strong show put up by all asset classes across the world. I was reading a statistic which said that except for Turkey, all the other ETFs of all the nations in the world have had a positive return in the first quarter. That's a telling statistic, right? I mean, there is a full-blown risk on across asset classes in the first quarter. Let's see how long does this continue to reward investors and traders. China too has seen its share, and while we're talking about fund flows into India, FIs have bought about $1.7 billion worth of Chinese equities on Friday alone. And that speaks the volume of the depth in the market, what kind of money it can take, and maybe that's one of the reasons why the Shanghai markets are doing so strongly over the last few days. And in today's session as well, Nikkei, Shanghai, etc., all have started well. But you can imagine the statistic that I'm talking about: $1.7 billion bought in a single day in China. That's arguably one of the best months since last 3 or 4 when it comes to the Chinese markets as well in terms of FI flows, or so the day in terms of FI flows. So pretty strong momentum across the world as well. For our markets, the last 1 month was pretty spectacular. If you just look at the 1 month MRR, you will see the kind of returns that we've given. It's been a strong 8% return, and amongst the stocks that have gained, Titan is the 10th best performer, and even that has double-digit gains in the month gone by. So it speaks volumes about the kind of month that we've had, and the flows continue. While I'm talking about China too, from an India perspective, as per our calculation, about 33,000 crores. These are the highest ever FPI monthly inflows into India as far as NSDL history records. So the going is good. Let's see how long it lasts. Lots of events to watch out for this week and in today's session as well. We'll see whether there is a reaction to the borrowing data or no. I'll talk about it on the bond yields, but this is an important monitorable, so do watch out for that. Auto sales data starts trickling in today, so we'll keep a keen eye out for that as well. Of course, updates on any kind of trade talks, because that's the trade optimism which took the US markets higher, which is taking Shanghai higher as well. And any updates on that would be materially important. And of course, our own monetary policy on April 4th. The decision comes out on April 4th. So this is something that we will all monitor with a close eye. However, amidst all of this and amidst all of the optimism that we're talking about, what are the stocks to monitor? That's the key word, right? What are the stocks to monitor in the session today? The going is good, but not for SRF. There is a regulatory blow for SRF. The Gujarat Pollution Control Board has ordered the closure of the Dahej plant. This is a large plant for SRF, It contributes about 70% to the chemical business revenue, and this closure will not augur well. So the stock already corrected about 2%. We were wondering why there was some serious selling in SRF in late Friday's trade. Now you know the reason why. You will see in all probability some selling in the session today as well. So do watch out for SRF. They are going, of course, going to take it up with the authorities, but the stock will have a problem in the session today. Welspun Corp, it's an interesting asset sale. For people who don't quite follow Welspun Corp very closely, one, that the stock has had a really good run, but all through the conversation was about what is it that Welspun Corp will do to deleverage further, get out of non-core businesses. A lot of talk around it, a lot of informed money has gotten into Welspun Corp already. From 80 rupees, I think the stock has moved up to 136, but this is an important development. Do watch out for this one. US FDA changes the status on Indoco's Goa unit inspection from a voluntary action initiated to an official action initiated, rather to a voluntary action initiated from an official action initiated. Is important. The stock was anyways active in Friday's session. Let's see what it does in today's trade. And lastly, expect the metal names to start off strong. We spoke about Chinese data, of course, but the manufacturing PMI has moved up, and that should only augur well for the metal stocks in the session today. So maybe not steel companies as much, but the base metal companies certainly should react positively. So let's wait and watch what happens here. The likes of Hindalco, Nalco, etc. should all be monitored. That's the trade setup for the day. Very strong show, very strong backing. The SGX Nifty promises a start in the green. So we'll have that to 11723. Let's wait and watch what we do from there. We have kissing distance of all-time highs. Let's tell you what's lined up on First Word today then on a day like this. Oil marketing companies may have a good fourth quarter. Sumit Sarkar Johnson to tell us why he thinks so. The last financial year was a very turbulent one for mutual fund industry, but there were a few that survived the storm. Nikki Mirchandani joins us to tell us about that list. Automakers may not share the cheer though. Yatin tells us why sales may have not picked up substantially in March. And then I try and take you through the government's borrowing plan and what experts have to say about it. After two disappointing quarters, oil marketing companies may have bounced back in the March quarter, fundamentally that is. The surge in crude oil and fuel prices that moved in tandem with it may have helped refiners grow their profits. Sumit Sarkar is standing by with a quick look at the quarter gone by for oil marketing companies. Sumit, how would it possibly look like?
Well, it would actually look like a good quarter for the oil marketing companies because they could record a good profit growth in the fourth quarter of financial year 2019 after seeing a fall for the last two quarters, that is the Q2 and Q3. And the reason behind this growth in the fourth quarter would be the strong gross marketing margin and the rise in crude prices. So first, let's see how the rise in crude prices will help these companies report a good quarter. So if you see now in the fourth quarter, though Brent crude, that is the Asian benchmark, has averaged lower, but the prices were continuously rising in the fourth quarter. As you can see here, it has gained nearly 27% in the fourth quarter of financial year 2019, marking its best quarterly gains in the last 10 years. And because of this rising crude prices, the oil marketing companies could report a lower inventory loss or an inventory gain in the fourth quarter. Now, if you see, generally, whenever crude prices have averaged lower compared to last quarter, the oil marketing companies have reported an inventory loss. As you can see in the third quarter of financial year 2019, the inventory loss reported by all the three oil marketing companies was close to 17,500 crore rupees, and that was because crude had averaged lower at around $68.81. But this in the fourth quarter, though crude is averaging lower at around $63.67 per barrel, the surge that we had seen in the crude prices could lead to a small inventory gain or a very small inventory loss for the OMC. So the fall would not be as bad as we had seen in the third quarter. Now, the crude prices had increased in the fourth quarter because of the growth in demand, supply cuts, and because of lower US oil inventories that we had seen in the fourth quarter of financial year 2019. Now, along with this rising crude prices, the fuel prices, that is the retail fuel prices, had also grown in tandem with the rising fuel prices. Now, because of that, oil marketing companies could earn a steady gross marketing margin in the fourth quarter of financial year 2019. Now, if you see in the fourth quarter, the gross marketing margin earned by the OMCs on sale of every liter of petrol and diesel, now that averaged around 5.85 rupees and 5.83 rupees, which is the highest in at least the last 4 years. Now, if you see the quantum quantum of profits that they have, earnings that they have made by selling this retail fuels, it is higher than the combined earnings that the oil marketing companies made in the second quarter and in the third quarter. So this rise in gross marketing margin would definitely result into good profits for the oil marketing companies when it comes to the marketing segment. But it will benefit more BPCL and HPCL, because if you see, the sale of retail fuel accounts for nearly 60% and 40% to their EBITDA, that is for HPCL and BPCL. So these two companies will benefit more compared to Indian Oil Corporation when it comes to the marketing segment. Lastly, the only dampener for the oil marketing companies could be the fall in gross refining margin. Now, though crude prices surged in the fourth quarter, the gross refining margins averaged lower. Now, the Singapore gross refining margin, that is the Asian benchmark, averaged around $3.2 per barrel, which is the lowest in at least the last 6 years. Now, because of this lower gross refining margin, they could earn less from processing every barrel of crude. Now, however, towards the end, if you see, of the fourth quarter, the gross refining margins did recover for the OMCs because of the refinery maintenance shutdown that we had seen announcements coming in from the US, Europe and the Asia, because of which the GRMs at the end of the fourth quarter did recover. But overall in the fourth quarter, they averaged lower at $3.2 per barrel. So that could be the only risk and the dampener for the oil marketing companies in the fourth quarter. However, the other two segments, that is on the inventory part and the marketing segment, they averaged very good, and because of that, the companies could see a good profit growth in the fourth quarter of financial year 2019.
Just a brief follow-up, Sumit. Based on these expectations, how do the valuations stack up vis-a-vis the recent history?
The valuations are still lower when compared to the 5-year averages, and that is because we have seen that they have been lagging the index growth rate, and that is because of various other reasons that we had earlier pointed out. But yes, valuations are cheap, but they are cheap because for a reason, because investors are not confident that going forward the companies will be able to maintain this record level of gross marketing margin that we had seen in the fourth quarter. So that's the reason the valuations are still cheap for the oil marketing companies currently.
Yeah, well, and the currency probably adds a little bit of a tailwind too, but let's see how long does this last. Sumit, thanks so much for putting that into perspective. That's Sumit Sarkar telling us on the first day of the new financial year about how strong a quarter it could be fundamentally for the oil marketing companies. Well, a bit of a switch from the future to the past. The last financial year was a tough year for the mutual fund industry. The ILNFS fallout led to a liquidity squeeze, prompting retail investors to withdraw their money. But there were a few funds that survived the onslaught. Nikki Michaudhany is here to take us through the list of performers in FY19. Morning, Nikki.
Morning, Neeraj. Without further ado, I'd just like to get into the large cap performers list as a whole. We have 3 stocks. We've picked up 3 stocks based on the AUM, which is more than 1,000 odd crore. Sorry?
3 funds, you mean?
Yes, 3 funds. 3 funds, I mean, where the AUM is more than 1,000 crore. And based on the top returns, these are the stocks that we have picked up in the large cap category. HDFC Top 100 Fund, where we have the 1-year return of more than 16% out there. Axis Blue Chip Fund, we have 13.8% return out there for this one financial year. And third on the list is Reliance Large Cap Fund, which has managed to fetch a return of around 13.5%. That's a tad better performance coming in as compared to their underlying benchmark index, which is which is Nifty 50 and Nifty 100 for the top 3 funds that we've picked up, which have managed to fetch a return of around 12%. So on an average, large cap category typically has fetched returns of around 14 odd %, which is tad higher as compared to 12% returns by benchmark. But if we're supposed to pick and choose among them, the consistent performers over different time horizon, that is over the period of 3 years and 5 years, given that 1 year in itself doesn't give a complete picture of how the funds could do going forward. If you look at that, HDFC Top 100 is right there at the list, top of the list, where the composition of this fund, 30% of which belongs to banking category. It invests majorly in banking category, followed by software and petroleum. And same is with Reliance Large Cap, which again invests more than 30% of its total assets in banking category as a whole, which is followed by pharma, which has been again a defensive counter for this one financial year, and 7% in industrial capital goods. So that's that in terms of large cap performance category. But if you look at the multi-cap category, that's where the outperformance majorly has come in from. This is despite the fact that we have seen a mix of both large cap along with the mid cap and small cap, which witnessed a lot of correction in this one financial year. Clearly, Neeraj, something going right for the multi-cap category funds, where the fund managers have managed to pick up the top good quality stocks importantly at the right valuation, which has fetched a positive returns for these stocks. Let's look at the list out there. Again, you have HDFC Equity Fund, which has managed to fetch a return of 14%, which is followed by Mirae Asset India Equity Fund, followed a return of around 13, and Parekh, which has fetched a return of around 11%. On an average, these funds have given a return of 14%, which is way higher as compared to the underlying benchmark index performance. That's Nifty 500 and NSE 200 index average returns of around 8%. So you can clearly see the kind of outperformance coming out there. One fund that we're supposed to pick out, given on the consistent performance across the time horizon, be it in terms of 3 or 5 years, we've picked up Mirae Asset India Equity, which holds again more than 18% of its total assets in banking category. Clearly, there is a pattern out there where the funds, if and when have they've invested in banking category, followed by software or for that matter pharma category, have managed to do or outperform their benchmark indices. Well, Mirae Asset India, if you look at the returns across the period that we have on 3-year basis, the fund has managed to show a performance of more than 20% returns. On 5-year basis, again a 20%. So across the board, we're seeing good amount of performance coming in from this fund. Small cap funds, now these are the funds which have apparently saw a lot of correction, but then some of them, we've picked a few of them which have managed to weather out the storm out there. We have right at the list topping is HDFC Small Cap Fund, which has managed to give a positive return in a period where the index has slid more than 16%, followed by Franklin India and SBI Small Cap Fund. On an average, the small cap category has fetched a negative return of 6%, but this, as compared to the underlying benchmark index, is far lower as compared to the correction of 16%. One fund which has typically done well over the past few period will be HDFC Small Cap Fund, which has managed to fetch a return of around 23% on 3-year period, and on for 5-year period, it is 21% kind of return. If I was just supposed to draw a pattern out here, Neeraj, so the first point that I would like to pick up is the multi-cap category outperformance, far exceeding than the benchmark index, and HDFC top 100, HDFC category, where it has managed to outperform all the mutual fund performance across the categories, be it the large cap, be it the multi-cap, or for that matter, even the small cap.
Interesting data, Nikki. Thanks so much for putting that into perspective. So every mutual fund investor, keep in mind, 1 year is not the ideal time frame to look at the fund performance, because a lot could change between year 1 and year 2. But that's the list of funds which have or have not done well. Thanks, Nikki, for that. Let's see what automakers will do and won't do well. They haven't completely recovered from the sales slump witnessed over the past few months. In March too, commercial vehicle makers and most of the two-wheeler companies sold lower number of vehicles than in the same period last year. Car manufacturers, however, managed to hold some ground. Yatin Mota is here to tell us what brokers expect from the auto sales for the month gone by, and which are those 1 or 2 numbers that he's keenly watching out for. Yatin, good morning.
Good morning, Neeraj. And I was laughing when you said that four-wheelers will hold ground, but those are shaky grounds. Sales are happening, but a lot of promotions, a lot of discounts, and you can read, of course, that piece on BloombergQueen.com, wherein we have done a comprehensive analysis of the auto sales estimates. Not only that, what are dealers and leading car retailers and wholesalers are talking about, because there is a lot of juicy discounts which are available in the marketplace, especially for the two-wheeler side as well as the four-wheeler side. But talking about Maruti Suzuki, that is one company to focus on. Again, like the trend which was there for the last 4-5 months, we are expecting that it will be a flattish month for Maruti Suzuki. Sales are expected to be close to 1.61 lakh units. Similar is the case with Mahindra and Mahindra, wherein the total sales are expected to be close to 60,000 plus units, growth of 1.5%, and this is largely to do with the new launches which has been there in the marketplace. They have already started deliveries of various new launches, because of which there will be a fillip in the overall number. However, if you look at the tractor segment for Mahindra and Mahindra, a 4% decline is what we're expecting for that particular segment. So watch out for the tractor side for Mahindra and Mahindra. Tata Motors, of course, there is pressure in the commercial vehicle segment. passenger vehicle segment also, despite the promotional offers, we have seen slightly muted sales. So a 7% decline is what we are expecting. 6-7% decline is what we're expecting for Tata Motors India sales. Ashok Leyland also, something like Tata Motors, will see a decline of nearly 3% in overall sales, which are expected to be close to 21,850 units. Bajaj Auto, this is one company to watch out for, a 15% growth. Last year base is smaller, but this time the export markets will be doing really well for Bajaj Auto. So there we are expecting a 15% kind of growth. However, if you look at Hero MotoCorp as well as TVS Motors, both will expect, and will see a decline of 11% and 2%. Remember, we had the FADA guys coming on Bloomberg Quint, and they were talking about as to how really is the inventory level high. A recent Ambit report said that a 80 to 90 day inventory is what Hero MotoCorp is sitting on. So it's obvious that this time the sales will be weak for a company like Hero MotoCorp. And finally, Royal Enfield, that is also one thing we'll be focusing on. A lot of brokerage downgrades in terms of target price as well as ratings on the back of weakening sales. And here also for the month of March, a 5% decline in Royal Enfield sales is what the Bloomberg Quint poll of 3 analysts is showing at this point in time.
Okay, interesting. I think so. If you were to watch out for one or two key names and the numbers, what would those be?
So,
long list?
Needed definitely Maruti Suzuki. The kind of promotional offers that they are giving probably has aided sales, but we don't exactly know as to what kind of a fillip that they have got. Poll is showing a flattish trend, so let's see how really that shapes up. Ashok Leyland will be an important number because the management has been talking about a pickup in March. That has not been seen. So let's see how really Ashok Leyland shapes up. And in terms of Royal Enfield sales for Eicher Motors is something we'll be watching out for, because the stock has been recently focused because a lot of brokerages are now talking about a slowdown in Enfield sales. We have to also see how their Kerala sales have shaped up, because that is one market which has never recovered. And with the elections around the corner, a lot of things happening in the state of Kerala in terms of pickup. Let's see how that piece and part moves.
Well, I mean, it's interesting to see. So watch out for Maruti, watch out for Ashok Leyland, and watch out for Eicher, the four-wheelers, the CVs, and the two-wheeler in that category. Jatin, thanks so much for putting that into perspective. The numbers start trickling in around 9:30. I believe Maruti will start coming in. So we'll keep a keen eye out for that. Okay, the last piece on First Word today is the borrowing data that has been announced for the first half of the next year. So the Indian government in the first half will borrow about 4.42 lakh crores, which is about 54% higher than the last year. And this is substantially higher. But a lot of people, as I'll come to as well later on, stated that this was maybe marginally higher than what was anticipated. Look at the whole numbers. So the gross borrowing in whole of FY20, 7.1 lakh crores. The gross borrowing in the first half, about 4.42. Net borrowing, about 4.23 for the full year, and about 3.4 lakh crores for first half of FY20. Now, what did the experts say and what did the government say? Firstly, what did the experts say when this number came out? And it was 54% higher, so naturally we got reactions. Soumyajit Neogi of India Ratings believes that, as expected, and I use the term carefully, as expected, the government will complete about 60 to 62% of the borrowings in the first half. The borrowings via longer tenor bonds as well are higher, and state development bonds are also substantial. Therefore, supply side pressure will push up long-term bond yields. Sivakumar of Axis, though, believed that the borrowings are only marginally higher than the market expectations. The impact, according to him, is expected to be marginal, and the yields may rise by a couple of basis points and not beyond that. Now, of course, the government tried to explain the reasons behind the borrowings over the first half, and Mr. Garg said that the repayment obligation of 2.37 lakh crores in the fiscal 20 in H1, about 1 odd lakh crores, is the reason why the borrowing number is so substantially higher. Keep in mind, it's spread across the tenors. So the point that Soumyajit Neogi was trying to make, that if you look at the borrowings in the first half across different tenors, 1 to 4 years at different yield points, of course, but the point that I'm trying to make is that, one, it is spread across the curve and not necessarily concentrated, even though you could argue, yes, that the longer tenor bonds, the borrowings are higher and the state development loans are also substantial, but largely it's spread across the curve. And the data for redemption pressures for the next few years quickly brings out that this may not be the end of it. The absolute number, because of the borrowing program that the government has had in the past and the redemption that comes up, we might actually have reasonably higher borrowing numbers coming in for even the next financial year and the year after that. As you can see by that, the debt maturity, and the debt maturity is a percentage of outstanding debt, which is an important parameter as well. That only keeps on moving up, and therefore, it shouldn't surprise you that the numbers are moving up. These will in all probability only move up higher. Maybe that's why Sivakumar is saying that the market kind of anticipated this in part. But of course, the yields may react, and we'll of course talk about that in greater detail during the course of the show as well. Keep in mind, the budget document pegs the redemptions lower in FY20, and if you just look at the gross borrowing versus net borrowing numbers for FY18, FY19 and FY20, you will see the difference that I'm talking about. But largely put, a much higher first half, arguably due to the higher redemption pressures that the government has, about 1 lakh crores in the first half, 1.01 lakh crores in the first half, and 1.35 lakh crores in the second half of redemption. And as a result of that, the borrowing numbers are high. We'll see what kind of impact it has on the bond yields at about 9 a.m. We will be on the lookout for that. And of course, 2 experts will join in to speak about that too. We'll have Hari immediately reacting, and then Suyash Choudhary coming in a bit later on to talk about this and what to expect from the policy as well on the April 4th. So this is an important conversation that you would want to watch out for. We'll of course carry on that conversation about markets and macros with Ravi, Sundar, Muthukrishnan of Elara Capital. So that's the other important conversation. And hotel stocks are on a bit of a frenzy. At least Chalet Hotels is. Rajeev Newar of Chalet Hotels joins in on the doors that are opening up for the space after nearly a decade-long struggle.
Welcome back. You're watching Indian Open right here on Bloomberg Quint Live. Good morning, Neeraj.
Morning, Ravina. And looks like a start which will be in the green, aided by global markets largely.
Yeah, and the focus stays on the metals pack. I mean, with the China economic data coming in so strong, PMI numbers at 50.5 has been the best since 2012. So that definitely looks like it could aid the entire metals pocket, which was the case in Friday's session when the entire metals bag moved up closer to 2.5%. I'm talking about the index, which moved up about 2.5%. And that could probably see a follow through into today's session as well. Banks are also going to remain in focus. Like Neeraj said, the setup looks ripe for a stronger open this morning. SGX Nifty is trading with gains of about 0.5%. That's 53 points higher on the SGX Nifty. But let's take a look at what happened in the futures and options space. Friday was the first day of the April series that kick-started. We had a new entrant, Britannia, that came in. Darshan, how was the setup on Friday?
Yeah, so basically there was a short covering that was seen on the market while the Nifty managed to move in higher. The Nifty Bank was rather flat in trade. So what we saw yesterday on Friday was open interest was down 4%. And the index was up 0.5%, so there was moving. There was a movement that was happening on the Nifty. What didn't do that well was the Nifty Bank, which was absolutely flat in trade. Open interest was down almost 2% in trade. Now, if you're looking at the wicks, the wick again has managed to move up. It's close to now over the 17 level. It was up 3%. Now, where a position is taken, I think the broad range, if you're looking at it, is the 10,500 is the big support level that the market is looking at this point of time. And at higher levels, call writers, this is what happened on Friday. In fact, at the 11,500 level, there was in fact writing at the 11,600, 700. Again, writing going on so gives an indication that the market trend is bullish. Where are call writers writing from 11,800 to higher level? With the SGX Nifty even coming in higher, there could be more short covering that would come in. Now, if you see what is happening here, 11,500 to 12,000 is where the big range for the market is. Call writers are active from levels of 11,600 to high level, but at this point of time, despite heavy writing from 11,500, 11,600 all the way to 12,000, it's the put writers that are making in the money. There is ample amount of money that's lost by the call writers since the market managed to move up. Now, a couple of the Nifty PCR managed to move to 1.49 from 1.96. It was the start of the new series. A couple of stocks in the F&O band. There's Adani Power, IDFC Bank, Reliance Power, which was very, very active in trade on Friday, has come into the F&O band. IDFC Bank and Reliance Power are the two companies which come into the F&O band. Now, as far as stocks are concerned, CEAT is something that you need to watch out for. Open interest build-up was 10%, fresh buying was seen. A couple of the tire stocks have been very, very active in trade. A couple of other stocks, BHEL actually managed to move up on high open interest build-up of 18%. No news as such, but the counter did manage to react positively in terms of high open interest build-up. SRF, look at the open interest build-up, 44%. Fresh short positions were taken at one point of time. SRF was down 4% before managing to cover it. But today, the counter definitely will react negatively on the closure of the Dahej plant. It's the most important plant that they have. Almost 70% of the chemical revenues comes in from that plant. And Nalco is the other one, open interest build-up of 10% on the long side. Metals, again, as Devina pointed out, is something that you need to watch out in today's trade.
Right, Darshan, thanks very much for that. So those are some stocks from a futures and options point of view that look active in Friday's session. Avinash Gorakshakar, the head of research at Joindre Capital Services, is joining us on the show right now. Avinash, various pockets that are going to remain in focus today. One being metals because of the pickup in the economic data from China. The other being cement, where cement companies are saying starting 1st of April, they're looking at taking price hikes, about 30 to 40 rupees per bag. And the third being the banking space, with the banking exposure norms kicking into action from today. How are you going to play these individual pockets?
No, I think clearly banking and cement could definitely continue to be in limelight. In fact, not only the PSU banks, but even the private sector corporate lending banks like ICICI, Axis could possibly, definitely see a lot of action, considering the fact that, now the consolidated merger of Bank of Baroda gets effective today. I would believe that, yes, I think, just ahead of the policy, I think there would be a lot of moves in the, in the banking space overall. But overall, the cement space continues to be quite, attractive, considering that the South-based companies could possibly benefit more. They had taken a hike earlier, and our sense is that companies which are pan-India based plus which have got regional pockets in South could definitely be looked upon. I think considering that 30 to 40 rupees per bag could actually incrementally add to their earnings, in fact from the second quarter of FY20.
Sure, they had taken price hikes, but they had rolled it back within 10 days.
No, I think net the rise would be there. I think they had rolled back, but again, if you look at the net increase, I think the net increase indicates that the incremental realization has obviously moved up from the previous quarter. So I think to a large extent, I would be more positive on the South-based companies, especially something like a India Cement or a Ramco Cement, where I would believe that these are definitely regional opportunities where possibly a risk reward could be much better.
Would you look at metals in any shape and form?
Metals, I would believe, I think we need to have a little more confirmation about data points. I think this data point which has come in from China is obviously encouraging, but I would believe that maybe, probably another one or two, maybe one quarter of encouraging news, because clearly global prices seem to have hit a roadblock, and I would believe that, within the metal space, I think Tata Steel possibly looks the best.
Interesting. So today maybe the ferrous space, the base metals could actually do really well in the session today. Could do well. Let's wait and watch. But Avinash's point about other data points being needed is also well taken. The other large pocket of monitoring today would be the auto numbers, yeah. Avinash. Maruti is expected to come out with a flat set of numbers, and I think all eyes also will be out for Ashok Leyland because they had indicated a pickup, yeah. Which is that one auto sales number that you're watching out for.
I think within the four-wheeler pack, I think what Maruti generates is going to be quite interesting, because it impacts a lot of auto ancillaries within the space. And our sense is that March is going to be even a bad month compared to February. We have been hearing that the company has been giving a lot of discounts to actually move out the inventories. I would believe that maybe till the June quarter we could see demand actually remaining quite sluggish, and quite frankly, Neeraj, it could happen that possibly the stock could come under pressure. I think hopefully what kind of volume growth comes in the next financial year is now going to be important. Largely the stock has discounted that March may not be a great month, and obviously the Jan to March quarter, which historically is supposed to be a good quarter, is going to be a fairly soft quarter this time.
So is that in the price though for a Maruti? My question is, if the numbers disappoint a little bit and Maruti would correct a bit, are these valuations that you would be comfortable buying?
I would believe that we could see a further possibly softness on the price. I would be surprised, if most possibly the markets have fully discounted it, because clearly I wouldn't be surprised that, maybe for 1 or 2 quarters, unless demand actually runs into double digits, we may not see a major re-rating in Maruti Suzuki. Maybe on the downside, the fall may not be significant, but on the upside, I think the stock could possibly just consolidate.
And this would be a reflection in their Q4 numbers also, right?
Exactly. I think for Q4 is definitely going to be quite sluggish, considering that volume, growth would not be there, and whatever price hikes they've taken, that has also been done selectively. So you're going to see margins pressure plus the top line, not moving as per what market expected.
All right, that's Maruti, and it has been under continuous pressure over the last few months now. In fact, many believe that the stock could actually even go sub 6,000. We'll have to wait and watch to see how that shapes up. But Q4 numbers definitely look bleak in the light of what's happening with the volume numbers as well. But let's take a look at what's been happening with regards to more stocks in news. SRF, that's going to be a big one in focus this morning, and how the stock opens up. Most likely, it's going to take a big knock in trade today. Mishika and Yash, both of them here with us. Mishika, let's start off with some stocks in news first.
Yeah. So let's have a look at Tata Motors' response to the S&P downgrade. The company says it's disappointed in S&P's decision to downgrade a Jaguar Land Rover now, because the company was expecting improved financial results in the current quarter compared to the first 9 months of the financial year, which is significant positive cash flows in the fourth quarter. Also, Tata Motors sold its entire stake in aerospace business to TASL for 625 crore rupees. The company also acquired non-aerospace business from TAL for 10 lakh rupees. Dr. Reddy's Laboratory says its Visakhapatnam facility has been re-inspected by the Regulatory Authority of Germany and is considered to be fully compliant. Cipla received 8 GMP observations and 10 PAI observations. These observations are both product specific, and GMP observations are related to the manufacturing and quality processes. There are no data integrity observations. The US FDA conducted a product specific pre-approval and good manufacturing practices inspection at its Kurkum plant from March 11th to March 20th, and this inspection covered 3 units at the plant. Then we have Indoco Remedies. US FDA has changed the inspection classification status from official action initiated to voluntary action initiated for the Goa plant. The company says this move signifies that the site has come out of the warning letter issued to the site in March 2017, and several pending ANDAs from this facility will now be approved. Lastly, we have Welspun Corp. The company will sell its plate and coil mill division and 43 megawatt power division for 940 crore rupees to Laptop Finance Private Limited. The PCMD is expected to fetch a consideration of 873.5 crore rupees, while the 43 megawatt power division is expected to be sold for 66.9 crore rupees. The PCMD contributed 16.9% to the consolidated revenues and 15.4% to the consolidated EBITDA of the company as of FY18. The sale is expected to complete by May 31st of 2019.
All right, Mishka, thanks very much for that. SRF, a big blow.
That's right, Devina. The big negative coming in for SRF now. This is on the back of the report that Gujarat Pollution Chemicals Control Board has actually given a notice for the closure of its Dahej plant. And now, why is this important? Dahej is the largest of the 4 chemical plants that it has, with nearly 70% of its chemicals business revenues coming from there, and approximately 40% of its overall chemicals business EBITDA coming from that plant. Now, what we've understood is that the Gujarat Pollution Control Board conducted an inspection of its industrial unit on March 25th, and what they found is that the company had 2 tankers of highly concentrated effluents for which it did not have the requisite approvals, as well as the fact that the Pollution Control Board does not allow the company to dispose those effluents at any common disposal facility. Additionally, the company had also installed a calcium chloride plant at its Dahej facility, for which again it did not have the necessary approvals. So on the back of all these observations, the Pollution Control Board has actually advised the power distributors to cut down any supply of electricity, and has immediately ordered for shutdown of operations at its plant. Meanwhile, the company in its press release has mentioned that it is in the process of filing a detailed report to the Pollution Control Board, so we'll have to watch out for that as well.
Right. Guys, thanks so much, Mishika as well as Yash. Avinash, quickly comment on SRF and the big negative that we're seeing for the counter now.
I think surely, I think even on Friday, the counter was weak. This news flow about pollution-related issue, wanting, which resulted in closure is going to definitely impact the stock, sentiment-wise today. And unless and until, the market does not get a hint as to how quickly this plant could get restated, could be very critical, because this plant actually contributes significantly to the company's overall earnings. So I would believe that yes, today could be a bad day for SRF, and I think going forward, how this plant gets reopened at the earliest would be the kind of data points the markets would be expecting from the management.
Interesting. I also remember seeing one more name, by the way. There's a company called Ruchit Decor. I don't know how big it is, but even they have received some closure notice from the Pollution Control Board for a laminate industry, sheet in manufacturing unit in Gujarat. So keep that in mind. Avinash, the only question is, the obvious reaction to any such piece of news is the management saying that we are going to appeal. And we know that that will happen. We don't know what the outcome of that would be. Until such time, for such an important unit like the Hedge being under this eye of the storm, what's the extent of downside that you reckon can come in? If not fundamentally too, there would be, because there will be loss of production.
Yeah.
But sentimental is higher than fundamental.
Yeah.
How much extent of the downside do you see here?
No, I think looking at the fact that this price, had discounted FY 19 and 20 numbers, I would believe that, Neeraj, if the plant remains shut for at least 1 or 2 quarters, that could definitely be a very negative factor, because incremental top line profitability could get impacted. So I would believe that, it's difficult to guess as to how far the stock could go down. But quite frankly, it could possibly even see, levels below 2000 if, the plant does not open. As I mentioned, this plant is a very important plant for the company. And unless they have a plan B, I would not be surprised that the markets would obviously, factor in this negative surprise in the earnings.
Do you track this other company, Ruchit Decor, at all? Because apparently they also have gotten such a notice from the Pollution Control Board in Gujarat.
We don't cover it, but typically I think, this is one of those mid-caps, from Ahmedabad, located, mid-cap. So I would believe that in a year, maybe the impact may not be very significant. SRF is a larger play, Neeraj, which has got larger institutional investors.
Yeah. And one more company, Avinash, there are 3 pharma companies which are in news today because of various reasons, US FDA, etc. I thought the Indoco one was the most important one, the change to a voluntary action initiated. It probably paves the way for clearance of the sterile facility as well. How big a development is this for Indoco? But the stock was up 8% in
I think looking at the price, Neeraj, I think there could be some further re-rating and some further risk reward, because the stock had been battered down quite badly, and this news flow is definitely positive. I would believe that whatever earnings impact comes in could possibly come in the next financial year, but definitely I would believe that this is a big positive for the company, and we could see definitely a further kind of re-rating coming in from these odd levels.
Okay. Got that. We'll see how all of these stocks react and trade this morning as we open up. But time now to bring our technical experts on board. Ruchit, Jain, technical analyst at Angel Broking, is joining us on the show. Along with him, Brijesh, Bhatia, head of research at Dealmoney Securities, is also there. Gentlemen, good morning to both of you. I'll start off with you, Ruchit, first off. On the index, 140 points away from a life high.
Hi, very good morning, everyone. Well, definitely, it has been a stellar month for the month of March, and what we have seen are not only a formation of a higher top, higher bottom structure, but the up move has also been supported by a broad market participation. This is a clear impulsive 5-wave up move according to the Elliott wave theory also. So, as of now, there are no signs of reversal. Even if you see during early last week when there was a dip, that dip was bought into, and post that we have again resumed this uptrend. So we should see this all-time high getting tested maybe in next 2 or 3 trading sessions itself. So we are advising our clients to continue to trade with a positive bias. On the Nifty front, 11,570 is now a support level on the Nifty spot levels. So at current levels, one can go long even on Nifty future at current levels, also expecting the earlier highs of October 2018 getting tested, which is around 11,750 to 770. Even on the Bank Nifty, we have seen that in the month of March, the leadership has been taken by most of the banking names. gain of about 13% in a single month, that we have not seen since many months, or we can say in last couple of years in the past. And if we see the volume flows, then the volumes have been not only in the private sector large caps, but also the mid caps as well as the PSU names have witnessed a very huge volumes in the banking space. So I think this leadership in the banking space is likely to continue going ahead. Since the index is now trading around at its all-time high, we usually use reciprocal retracement theories to target for predicting the next set of target zones. And as per reciprocal retracement theory, the target for index is coming around 30,900 to 30,950 zone for short term. So even Bank Nifty, we are expecting this momentum to continue towards 30,900 kind of levels.
Okay, got that. That's on the indices there. Brijesh, let's get in your index strategy.
Good morning, Devina. I would still continue with the long on the Nifty and Bank Nifty both. So if you look at the Nifty, we have seen a stellar month of March, and after nearly 4 months of consolidation, indexes broke out of the forming the narrow range squeeze, and we have seen a strong rally coming in the March. So I think with this momentum might continue in April, and I think till mid-May we might see maybe 12,200, 12,400 levels as well. But purely from a momentum based, one can look for a target of around 11,780, 790 to around 11,844 in the momentum, and keep a strict stop loss of 11,540 on the spot.
All right, so the consensus is that you will breach your previous record high at 11,760 from both our experts within a few days. Let's talk about individual stocks then. Ruchit, let's take your call on Varun Beverages, and you've got a buy on Ramco Cement.
So Devina, we are focusing more on mid-cap names now from a trading perspective. We have seen that we have already spoken about banking, how it took the leadership in the month of March. But also if we see the mid-cap index, then on the weekly chart, recently the index took support around its weekly 200-day moving average, and the close for the month has been above its intermediate high of 18,095. So this is indicating that in the month of April, at least in the first half, we would see many names from the mid-cap space showing a very sharp up move. So I have two buy calls both from the mid-cap names. One is Varun Beverages. 7 months of consolidation phase was there, and that consolidation phase on Friday's trading session, the prices have given breakout with a gap up opening. The volumes are very high in the last few trading sessions, which is indicating that buying momentum is likely to continue. So traders can go long in Varun Beverages for short term with stop below 805, expecting target around 970. And cement is one sector where we have witnessed good volumes during last week. ACC, Ambuja, Ultratech, and from the mid-cap space, Ramco Cement is. These are four names that we believe that would show some outperformance compared to in the markets. Ramco Cement from the mid-cap space could be bought at current levels, keeping a stop loss below 709, expecting target around 775.
No, sorry, I was saying so Ruchit is basing ideas on the mid-cap space. Brijesh is still sticking to the large caps because his ideas are a large bank and a large cement company.
So yeah, if you look at HDFC, it is being on a roll now after long consolidation, breaking out of around 2270, 2280, and then back to around strong rally. I think this rally would continue, and if you look at the volumes also, they are nearly at 8 months high on HDFC. So I think this momentum might continue towards 2420, 2430 on the upside on HDFC Bank. So one can initiate long at around 2319, keeping a stop loss of 2269 on the downside. And as Ruchit has clearly mentioned, cements are breaking out. So we have created a proprietary index of cement with equal weighted stocks, and that index has broken out of nearly 8 months range. And if you look at the RSI, it has been moved about 50 levels now, so which is into the bullish zone. So yes, a cement space would again be a good rally for the, and that could be the flavor for the month of April also, I think. And one can look on Ambuja Cement at around 235, keeping a target of 255 to 268 on the upside, and stop loss would be around 225.
Okay, got that. Some stock ideas there from our trading experts. But moving now on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock today?
Morning, Devina. Metal stocks are going to be in focus today, and notwithstanding the positive news coming in from the manufacturing data from China, most metal stocks have been buzzing in trade over the last week. JSW Steel being one of them, and the proprietary trender indicator has given a positive signal. As usual, before we go any further, let's first try and understand what the trender indicator is and how do you interpret it. So basically, the trender uses the average true range for the purpose of calculation and generates a buy or a sell signal. How do you interpret it? You go long when the trender indicator changes its color from red to green, and you go short when the trender indicator changes its color from green to red. In the case of JSW Steel, what has happened is that the trender line, after giving a false breakout from its green color, turned to red, and with the move that we saw in yesterday's day of trade on the back of higher than average volumes as well, the stock has moved above the trender mark. So the trender line over here, that is at the mark of 290, when the stock managed to close at 293. We had a fantastic rally for the stock from the levels of almost 275 to close to 300, but it's somewhere faltered and the trender line changed its color to red again, but it has managed to take it out once again after gaining for the last 4 trading sessions. Also, what we've done is that we've taken a longer term picture as well. So we are looking at the monthly chart of JSW Steel, and we've taken the MACD indicator as another parameter. What we've seen is that after a very long period of falling from the levels of 400 plus to as low as 275, the MACD indicator, that too has given a positive crossover. So the blue line, that is the MACD line, that has crossed above the signal line to give a positive divergence, which adds up to the fact that the trender too is giving a positive signal.
And how well has this worked in the past, Ash?
So Devina, for the trender indicator specifically, 3 out of the last 6 times that the indicator has turned positive, it has managed to give returns in excess of 8% over the next 1 month.
Okay. Yes, thanks so much for putting that into perspective. So the metal names, do watch out for those ones. Actually, we spoke about the metal space with Avinash. Maybe just get in our experts to talk about this. Ruchit, just a quick thought. SAIL, JSPL, etc. were very active in Friday's trade. The Chinese PMI data, in all probability, would lead to for it to be a sentimental positive. Would you trade any of these names?
Yes, if we first look at the Nifty Metal Index, then the index gave an up move during the month of February. In March, although we have seen a broad market participation with the indexes going up, but the metal index has relatively remained sideways. But if you look at the price data, then in this entire range, in this entire consolidation phase in the month of March in Nifty Metal Index, the 20 days moving average has acted as a support. Secondly, even RSI has formed its base around the 50 levels, which is indicating for short term, we would see resumption of the up move that we had seen in the early February. So I think next 1 or 2 weeks perspective, metal stocks should show some positive move. We like Vedanta, Jindal Steel, and even JSW Steel, which you have just shown there. So these are the 3 names from the metal space, which I think from a near-term perspective could give good returns to short-term traders.
Well, so that's the metal space, of course, and very active in Friday's trade. The data suggests that there could be some activity today's session as well. So there could be some moves that we might see in some of the metal names today. Avinash, I was looking at stocks which are trading at 52-week highs. There are a bunch of them, of course. I have picked up 2 or 3. Adani Gas, 10% higher. Various reasons notwithstanding, what's your view fundamentally on whether it's a good stock to stay invested in, or because of the runway move that we've already seen, or would you be tempted to book some profits here?
No, I think clearly, Adani Gas has got, fresh licenses for the city gas distribution space. But incrementally, I would believe, Neeraj, it would take a long time before we could see some numbers coming in, from this business. I would believe that, at least investors who have the stock should hold on. But fresh buying at these levels could be avoided. I think within the gas space, we still continue to like the bigger players like an MGL or maybe a Indraprastha Gas. I think where obviously the opportunity for the volume growth and the overall pricing is much better than Adani Gas. Adani Gas is a new player, and I would believe that considering the fact that the visibility in numbers is much better in MGL and IGL, I would preferably avoid Adani Gas.
All right. IGL on the charts, the last 1 month done nothing actually, Brijesh. Would you be a buyer here? Are the indicators suggesting any movement of any sort?
I think better than IGL, MGL is the best play, and it has been trading at all time and strongly outperforming in the against the IGL. So the momentum is clearly towards bullish. Then I think one should look for outperformance rather than underperformance. And 1100, 1130 could be seen on MGL, so that would be a pick for me.
All right. The other pocket that was active since the entire last week was the housing finance companies. Indiabulls Housing for one, the last 7 days has gained about 17%. So that's the kind of interest that's coming in. Not just Indiabulls Housing Finance. You've got a Canfin Homes, Repco Home Finance, all of these names. Dewan Housing Finance for one, leaving aside the cloud around it. The stock actually did not do all that badly. Last 7 days, 10% higher for even a Dewan Housing Finance at 150. Would you be a trader on any of these names, Ruchit?
Yes, Canfin Homes among this entire housing finance space has witnessed good volumes in last 1 month. So if I definitely Indiabulls Housing Finance up move has also been shown a breakout during last week. Now the thing is that if you look at Indiabulls Housing Finance, the last 4 or 5 months there were continuously short positions being formed in the derivative segment, and those short positions were being rolled over series on series. But in the month of March, when we saw a broad market participation, there was a breakout above the resistance levels, so which led to this short covering move. The volumes are good, so we may see some good up move in Indiabulls Housing Finance as well, but the breakout level was around 700, so the risk reward ratio at current levels now is not favorable to take a fresh long trades, at least from a trader's perspective. Any existing long could be held for short term target around 905, which is the 200-day moving average. Now it would be crucial this month to see how the prices behave once it reaches this 200-day moving average. But the volumes flows that we have seen in Canfin Home Finance, this certainly indicates that there's been a good buying interest in this stock, and on the higher levels on the weekly chart it is indicating probable targets of 410, 420, which is about 20-25% higher from current levels. So at current levels within the housing finance space, Canfin Homes could be bought with stock below 316, expecting target around 400.
Interesting. HSBC's come out with a note on financials, of course. On the large cap space, they like HDFC Bank and IndusInd Bank. From the NBFC space, they like Mahindra and Mahindra Financial Services. Their target price is at about 496 rupees per share, current 421. Avinash, Gorakshakar, the situation may have become slightly normalized for some NBFCs, maybe not for some. If you were to place a bet on one NBFC name right now, which one would that be, if at all?
No, I think, within the private sector banks, I think we like RBL and Axis Bank, and from the NBFC space, we still continue to like Edelweiss. Our sense is that, I think we could see a much stronger and a much good year as far as FY20 is concerned. And I think on all parameters, the asset quality, the loan book growth, plus the kind of action happening in the capital market is going to obviously give a leg up to Edelweiss investment banking business. Our sense is that, below 200 could be a good buy, and probably keeping a timeline of at least 12 to 15 months.
The fact that they've recently got funding for ECL finance as well, and things are working for them on other parameters, while they took the sharpest knock when the NBFC issue broke out.
Exactly.
Are they going to weather this well in the sense of the kind of earnings performance that you can see?
No, I think they have definitely, have a good liquidity kind of chest which could possibly withstand the kind of liquidity crunch which we saw post the ILFS NBFC issue happening. Our sense is that, if you look at this company from the lows of around 125, 130, it's bounced back. And I think as long as they get, liquidity for, their businesses, they have been quite aggressive on their wealth management business. There also some funding has come in. So I would believe that, yes, FY20 should be a lot better. And I think they are definitely well positioned to withstand these kind of shocks.
The notes are interesting, Devina. Some of the notes suggest that the situation has turned to near normal for a lot of large-sized NBFCs. It's almost as if RNFS didn't happen, or happen, it's completely absorbed.
They've come back to their mean. I mean, they've reverted back. So even with regards to, while they're just a little bit more skeptical in the kind of disbursements that they make, the other parameters firing on all engines. 17 seconds left to go for market pre-open, so we're going to watch out for the open here on our bourses, pre-open rather. SGX Nifty pointing towards a stronger start. Rest of Asia looks extremely strong, 2% plus for Japan. You've got Hong Kong, even China trading in the green. 44 points higher up on SGX Nifty. Nifty 50, that's marginally negative. Sensex is up 1/3% or so, not much, but you'll keep having volatile changes on the index for the first few minutes at least of pre-open. They're going to stick to some of the stocks and see how they're reacting in trade. Watch out for all of the auto names ahead of the auto sales number. So a top draw on Bajaj Auto, that shows a 9% move, but that's a little bit of an aberration. We'll wait for that to cool off. GAIL is up 2%, Hindalco is up 1.9%, Vedanta, all of the metal names, that's what's going to gain traction in today's trade as well. Britannia, not a bad session Friday, first day of its entry into the index, and not a bad session, at least at the start of it, 1% higher for Britannia. Eicher Motors, that's at 20,800, LNT moves up 1,400 past on LNT. Tech Mahindra, IndusInd Bank and Grasim, some of the other bigger gainers. It's more about the gainers than the losers this morning. A handful of 10 stocks losing out, with the worst performer being Cipla. But that will also cool off. It's showing you a 5% downtick, but that will come off as well. That's what you've got on the Nifty 50.
The bond yields firstly, and then SRF, the next one. Firstly, the bond yields, the borrowing program, and let's see what's impact it's had on the yields in the session today. 7.35, so nothing material. I think as Sivakumar was saying that he expected a couple of basis points increase and not more, because this was just marginally higher, the borrowing just marginally higher than what was anticipated. But 7.35, no material reaction. The rupee had strengthened a little bit in Friday's trade. Right now, well, yeah, a little bit of further strengthening maybe, but nothing too dramatic either, 0.25% or thereabouts. SRF, from a stock specific perspective, let's pull that one up and see if that plant closure notice has had an impact. Naturally it has. The pre-open rate suggests a 10% downtick. Let's wait and watch. Anything could happen. I wouldn't guess as to what's the extent of damage that could come in on the stock, but let's wait and watch. Maybe Ruchit Decor is the other one which has gotten some notice from the Pollution Control Board. Let's see if that one has any impact. No, not so much. Indoco Remedies starts off looks like starting off on a positive note, so that one could be okay. I think Care and Lakshmi Vilas Bank have some different moves. LVB though, 2 days on a trot now, and a stock with reason for moving up is up about 10%, so do watch out for that. Lakshmi Vilas Bank. And lastly, Jet Airways. The newspaper reports suggest that Adani's may put in a bid for Jet Airways too. Well, you never know who could be the white knight, but for now, no big reaction on Jet Airways. Anyways, we'll monitor these stocks once the pre-open rates have settled down. First, let's get in Somit Sarkaru Johnson with the top brokerage calls for the day. Somit, good morning yet again.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Goldman Sachs on Crompton Greaves Consumer. Now, the brokerage has upgraded the rating on the stock to buy from neutral and has also hiked the target price to 260 from 214. Now, according to the brokerage, Crompton is expected to benefit from sustained growth in rural India due to its high exposure through the fans and the pump segment. Now, along with this, the brokerage also expecting the margins in the lighting business to normalize at higher levels and new product innovation to drive growth for the company. Lastly, it says that it prefers CG Consumer over others, as it offers a favorable risk reward in a sector where multiples are already elevated, with near-term growth having peaked out. Second we have is on Indian Metals, where HSBC has made adjustments for lower commodity prices and the appreciating rupee, which has resulted into a cut in EBITDA estimates by nearly 8 to 21% for Hindustan Zinc and Vedanta. On the back of this, it has cut with Hindustan Zinc's target price to 250 from 260, but has maintained its hold rating. For Vedanta, it has downgraded the stock to hold from buy and has cut the target price to 200 from 290. Now, this is not only because of higher commodity prices, because of lower commodity prices and the forex movement, but also because of the risk on capital allocation and higher dividends. Now, it also says that the deviation from capital allocation strategy is likely to act as an overhang for Vedanta. Lastly, it says that the higher debt at parent company could also result into sustained high dividend payout, which in turn would limit the downside and thus the hold rating for both these stocks.
Right, Somit, thank you very much for that. That's the early morning brokerage calls that Somit just got to you. Since we were on the topic, and Neeraj highlighted Jet Airways before we actually moved on to the brokerage calls. I mean, now that the Adanis are interested, and the fact that the option still also lies with Etihad. I mean, they have 24%, and they can go up till 49% FDI. So, do you feel that they can weather this out?
See, I think clearly, Devina, the key issue is going to be the funding part. I think clearly if the funding comes in, then I think they are again back in business. But I think clearly looking at the fact that banks have now taken over and they are looking at a buyer in the next say 2 to 3 months, I would believe that there are many suitors like Tata's have actually shown some interest. Adani's have also, according to news reports, have also decided to take a call. I would believe that once this liquidity flow happens, that would be possibly a time where all this uncertainty would end. So as of now, I think it's difficult to take a call, but I would believe that yes, something definitely positive happened, the stock could move up. In the near term, it's going to be extremely range bound till we get a final result from these kind of news flows.
By the way, while the big stock is SRF, Avinash, before we thank you, just one call on another stock in news, Welspun Corp. They're going to sell those assets for 940 crores, something the street was watching out for as well.
Yeah.
What do you make of this announcement? The stock looks very active today.
No, on a prima facie basis, the kind of consideration, Neeraj, is quite attractive. They have a market cap of roughly 1,300 crores, and the amount of money they would be getting is 940 crores. So it amounts to almost 25% of their market cap. But yesterday's news flow indicated that the net asset value of these assets was roughly 1,300 crores, and they are selling it out for 940 crores. So the markets would possibly like to know whether the company books a loss on these assets. I think clearly in today's conference call we could come to know, but at least prima facie this news flow is positive.
Okay, that's on Welspun Corp. Aside from Deepak Nitrate, just one last question which we've spoken about earlier. Anything new that's come up on your radar?
Well, I think clearly within the NBFC space, we also continue to like M&M Finance. We believe that we could see stronger traction in the year coming forward, considering that most of the asset quality concerns now management has clarified that now would decelerate going forward. So I think M&M Finance obviously is a stock which could possibly outperform after a long phase of underperformance.
Well, HSBC is positive too on this one. Avinash, thanks so much for taking the time out and being with us today. Really appreciate your time. Okay, as the pre-open rates are settling down, Cipla is amongst the top losers on the Nifty, at least, or in the large cap space. So do watch out for that stock. The company's received 8 GMP observations. Observations are both product specific and GMP observations related to the manufacturing and quality processes. There are no data integrity issues, but the stock starts off a couple of percentage points lower today. Brijesh, you want to come in with a chart check out here? Cipla?
I think stock is trading in a range with lower high. Let it break around 540 to 43 and before we see a good up move. So that could act as a resistance zone 540, 542. In case it moves above those levels, one can initiate long, keeping a strict stop loss of 525 on the downside and look for a 570, 575 on the upside.
Interesting. Okay. SRF looks like being the top drag at the broader end of the spectrum as the pre-open rate settle down. That one is down about 4.5%, 2,300. Ruchit, what's the trading call here on SRF?
So Neeraj, whenever we see such huge gap down openings or gap down or gap up openings on the back of some overnight news, the first half an hour is usually most critical, because what happens in the follow-up move after gap up or gap down opening, that is more important rather than this gap now. So if we do not see any kind of buying coming in the stock in the first half an hour, then I think we could see the stock correcting further even from this pre-opening levels which we are seeing towards 2000 levels, which are the 200-day moving average. So at current levels, I would tend to avoid any kind of bottom fishing after this gap down opening. In case if we do not see any follow-up buying in first half an hour, then wait for levels around 2000 which could be seen.
Okay, and of course we'll watch out for the money market reactions tomorrow as well. The rates that we shown, of course, were of Friday's session, but the money markets could react, won't react too much, but the bond yields could inch up marginally on account of the borrowing data. So that data will be known tomorrow. But let's talk about all of that and more with our fundamental guest of the day, Ravi Sundar Muthukrishnan. He's head of institutional equity research at Elara Capital with us on the show. Ravi, so good having you. Thanks much for joining in.
Thank you.
What has been your advice in this whole big risk on, and it's not just in India, we're looking at how different asset classes, S&P 500, crude, the ETFs across countries, all of them have had in some ways or the other the best quarter since a few years. What do you tell clients to do now if somebody were to ask you that, hey, you want me to buy India, but the valuations are exorbitant?
Yeah, so what I see now is, in spite of all the risk on which we are talking about, there is still a lot of focus on large caps. So between, YTD, I think the large caps have significantly outperformed the mid caps. In our note last week, we said the time has come for the mid caps to start outperforming.
Okay.
So we based it on three major conclusions which we drew. One is, if you see historically, the mid-cap performance, 1 year it's a positive return.
Ravi, can I request, we'll take the detailed answer in a bit, but just if you can just entail what the three reasons are, and then we'll talk about the reasons in detail later on.
Sure. One, we said it's about the valuation stuff. We think mid-caps are significantly undervalued relative to large caps.
Okay.
The second thing we are saying is that FII flows, because of the pause in the Fed rates, are going to be stronger. And we see that in the mid-cap space also, there are a lot of stocks which qualify to be bought by the FPIs.
Okay.
The third is, for the first time, we're seeing some visibility about earnings recovery. So on these three aspects, we said mid-caps is a good bet relative to large caps. Though, of course, they are underperforming significantly even today because of the volatility and because of all the risk in the markets because of elections. But my sense, at the end of the year, we should expect the mid-caps to outperform large caps.
So I thought we'll talk about all of these 3 points in just moments from now. Ravi, the market's about to kickstart trade. So we'll just tell our viewers all that they need to know and then get in some top trading ideas from our technical experts. But first, all that you need to know to stay ahead in trade today. First up, SRF says that the Gujarat Pollution Board has closed down operations of its Dahej plant. The plant contributes 70% of the chemical business revenues, as per a report from Citi.
Cement stocks will be in focus today as Bank of America says a joint effort for a pan-India price hike push of 3 to 9% is likely from today. They say cement companies across major regions in India have communicated to dealers of a major price hike.
Positive news for Indoco Remedies as US FDA classifies its Goa plant as a voluntary action initiated from official action initiated, paving the way for new approvals. The stock likely to start off 7% higher in trade.
JSW Energy says it will not pursue the electric vehicle business due to higher than anticipated uncertainties associated with it. Instead, they will maintain capital cushion for growth opportunities in power and other related businesses.
Goldman Sachs upgrades CG Consumer to a buy with a revised target of 260 rupees per share on faster growth and attractive valuations.
And JP Morgan raises Jubilant Foodworks price target to 1600 rupees from 1430 rupees on new menu, technology capabilities, strengthening and new geographies.
Well, it's looking rock solid for a lot of these names. The brokerage calls have been very, very bullish. And we'll talk about some of these, some of the stocks and some of the themes that fall within Elara Capital's purview in just moments from now. But about 2 minutes left for the markets to kickstart trade. Good time to get in some top calls too. Just before we do that, the top mid-cap stock seems to be Indoco Remedies. Brijesh, a quick thought out here. 8% Friday, 7% today. Is there more steam left?
Definitely, Neeraj. So if you look at the stock, it has been moving out of its rounding bottom formation, and I think still good upside. I guess around 287 is the formation targets being coming on the upside level. So yes, definitely a good bet on Indoco.
All right, some top trading calls then with our technical experts. Brijesh, I'll keep it with you.
Apart from HDFC and Ambuja, we discussed, I would look to go long on Grasim as well. So if you look at the Friday session, stock has broken out of its head and shoulder formation and inverse head and shoulder formation, which is the bullish pattern. And one can look for a target of around 890 to 912 on the upside, keeping a stop loss of 842.
Okay. And Ruchit, what about you?
Since metals could be in momentum today, so I would recommend buying NMDC from the metal space. The stock has already corrected during last week and is trading around its support level. One can go along with stop loss below 100 rupees for expecting short-term target around 112, 113. So with a risk-reward ratio of around 1:3, I think this looks one of the most favorable bet amongst the metal space at current levels.
Okay. While we spoke about Indoco, which is up 7.5%, the bigger gain is coming to a Lakshmi Vilas Bank, which is up 10%. While we would have spoken about it, but just quickly, if it does open 10% higher, what does one do? Ruchit, quickly, 10 seconds.
So I would recommend to continue holding long position if any, because after gap up opening of 10%, the risk reward ratio won't be favorable to go long. And from a short term perspective, the targets would be seen somewhere around 85 rupees, which is the 200-day moving average.
Wow. Well, so another stock which had a very good session in Friday's trade and moving up 10% in today's trade on news. Indoco 8%, 7% on news. On the flip side, SRF down about 2% in Friday's trade, 4% in today's trade. So lots of stocks trending upside, downside. We'll talk about some of these in just moments from now. But here's how the markets are starting off. The world markets are a very happy place, mind you. We're not as strong, but still starting off well. We had a bit of a rally in Friday's trade, of course. So 0.5% up move for the benchmark indices. 11680 now, roughly about 90 odd points away from all-time highs. This is a ticker that we'll monitor very, very closely for the Nifty. So do watch out for that. The mid caps and the small cap indices will come up on your screen, and let's see what they are doing. About 0.5% a piece. Not exactly 0.5%, but almost there for the small cap space. The mid cap index about 0.6%. So good start. Ravi was speaking about how there could be a move towards mid cap buying. Let's see if that strengthens even for the 135 odd points now. So it's a strong start for the broader markets for sure. The market rate would be positive. The heat map, and let's see what's moving and what's not. Oil marketing companies correcting a little bit in the session today. ONGC marginally off, but the day belongs to the gainers. Let's see what's moving. Metal names, and no surprise there, the Chinese PMI data very, very strong. The large caps have started off very well. Vedanta, JSW Steel, Tata Steel, Hindalco, ferrous, non-ferrous, almost everything is moving around. Tata Motors about a couple of percentage points ahead of the monthly sales data that comes out. Some strength in Ultratech Cement. There were reports suggesting that price hikes could happen across, or rather pan-India. Let's see if that happens or no. Hero Motor Corp 2 ahead of the numbers. Autos haven't had a bad start. I think this is more a reaction to the markets doing well, that autos too are participating. But by and large, a lot of green, very little red. Cipla is the top loser, down about 2 percentage points. Very quickly, before I hand it over to Devina, just 2 or 3 pockets that I want to highlight in the session today. Firstly, needless to say, SRF, that was amongst the top draws early morning, 5.5% lower, 2269 and counting. So this takes the total tally to somewhere around 8% in 2 days alone on the back of the closure of the hedge unit. Let's see what happens here. What about stocks that have been doing well? Firstly, metals, and I spoke about the large caps, but the mid-cap names too have done very well. So JSPL, SAIL, NALCO, all three start off on a very positive note. Chinese PMI data, as I said, very strong. And then stocks which are trading near about their new highs, maybe bring those up and see what they are doing. Adani Gas, 10% up in Friday's session, another 1.5%. SKF, slightly soft. And IPCA, which has had a very good run in the recent past, up another 0.5% in trade. Devina, what are you spotting?
Well, you spoke about most of the stocks in news there. Lakshmi Vilas obviously being the top performer. Welspun Corp's not doing all that badly either. The stock is up about 8% in the session to sell its plate and coil mill division. The stock's up handsomely. You've got Orient Cement, which has moved up. Remember, the last 7 days have not been particularly good. So this one now up 5%. SAIL has moved up to 3.5% higher. Varun Beverages, that's I think Ruchit's stock idea for today, but that stock's up about 3.5%. Marico, Nalco, both of them up 2.5%. Bank of Baroda, now this is the merged entity. That's up about 2.5% right now. JSPL, Moil Persistent System, Marico, Jindal Stainless, Tata Motors DVR, and within the housing finance companies, everything's doing well. Godrej Properties, remember the stock moved up to levels of past 850, around 850, 860. From there, it came back down a bit. Today's session has seen a little bit of a revival, a comeback, 831 on Godrej Properties. But nonetheless, it's a very strong start. The advanced decline ratio, 955 stocks have advanced, only 240 stocks that are trading in the red right now. So a decent opening, no one's complaining on that count. Ravi, let's get down to what you pointed out earlier on, and the 3 factors that we were talking about: the FII flows, the valuations, and the other list of things that you wanted to highlight.
Okay, so going back to the valuation part of it first, what you need to do is look at the returns from Nifty year after year for almost 10 years in the history. You will realize that every alternate year, Nifty returns have been negative. So last year it was minus 15.9%. And the second thing is, every time it turns positive, the positive return is far higher than the negative return. So if it's 15.9% negative last year, it should be at least 15% positive this year. That's for the first take we have on on the mid caps. The second thing is till FY14, what you have realized is that the mid cap, large cap premium has been exceedingly good. Mid caps have been always at a premium to large cap from FY14 to almost FY17. That's 4 consecutive years. FY18, the number has been pretty bad. It's minus 18.9%. Even now, YTD, the discount is still there, which is large caps trade at a premium to mid caps. So having said this, sometime the reversal has to happen. So whether you look at it as on an absolute basis, or you look at a 7-day moving average, you will see that today's discount for mid caps is almost at the 2014 levels. So it can't go worse than this. That is what we're trying to say. Now, in this volatile markets, you realize that most of the investments are generally in the large caps. Not much of action still has not happened in the mid caps.
Yeah, they're flat. Mid cap index is flat.
In this volatile market, at least till the elections, what we've been telling people is, if not the asset class, mid cap as an asset class, look at least mid cap quality stocks. Pick them up right now, and also mid cap stocks where the earning visibility is pretty good. So these are the 2 categories of stocks we are recommending investors to buy.
It's interesting you bring up the mid-cap trends, historical trends, because this being an election year, there's another trend that we had culled out, and we figured out that every election year, the calendar year, the run-up till the election has seen mid-caps underperform. And post the results being announced, there's been a heavy rally in mid-cap stocks in that particular election year. So for 2014, that was almost 46%. 2009, you saw another 43%. That's post-result rally that came in. So is a tactical play something that you would approach this election?
So I don't believe about markets outperforming, underperforming during election years, because irrespective of whichever government comes into play, my sense is the market will have its own course post the elections.
No, this is just history and how it's played out.
Yeah, but for me, more important here is because of the significant undervaluation you are seeing today, that's the reason why we're giving a call on mid-caps outperforming. Election years really don't matter. Actually, stock performance in election, they probably will have an impact for the first 3 months maybe, but after that, the economy has its own course. It's your earnings, it's your GDP, it's all that which will come into play. So my sense is mid-caps will outperform. The other point we were making is about the FPI flows. Now, because of the pause in the interest rates in the US, we are sensing that more flows will happen to India, which is already happening. Will India attract more flows? The answer perhaps is yes. The reason being, India is more of a consumption-led story, whereas most of the other EMs, they are mostly export-oriented. Some of them significantly export into China. So with the global slowdown and the domestic story for India being reasonably good, my sense is more flows will happen to India. Now, even the DIIs, for example, SIP flows have been pretty strong. About 8,000 crores a month is what you've been seeing. The lumpy investments have not happened. That has actually declined. Now, look at the markets today. The interest rates are expected to fall. The real estate, despite all the type of SOPs the government gave in the budget, doesn't seem to have really taken off in most of parts of India, especially where equity culture is very strong, which is Maharashtra and Gujarat. The real estate market has still not gone too much, significantly high. That's what we were trying to point out in our report. So which would mean that more money will still come back to the equity markets through the DII flows as well. So that is the reason why we say flows being strong, mid-caps valuations being reasonable, I think it's the best time to pick up mid-cap stocks. So we, like I said before, we categorize the mid-caps. What among the mid-caps one has to look at? We talked about quality mid-cap stocks, and we talked about stocks with earning visibility.
Interesting. So, out of the 3 points that you made for mid-caps, relative valuations, I can figure out myself. Earnings recovery also quite, you can look at brokerage notes and figure that out. The interesting point was where you believe that there is scope for FI flows to come in. Now, the month of March as well, we've largely seen flows go to the larger pockets. Which are these themes? Which are these stocks? These are not recommendations, of course, from your end. You may not be able to talk stocks. But which are those names wherein you believe that FI flows have the potential to come in? And what are the reasons for that?
Okay. If you look at the mid caps, now let's go back to the investment thesis of most of the large caps. I mean, most of the FPIs. So what they generally tend to do is they look at market cap as one criteria, liquidity as another criteria. Now, if you see the mid caps, almost about 32 to 35 stocks qualify for the type of liquidity and market cap guidelines which the FPIs look at to invest. So to that extent, you have a bigger basket of mid caps to invest in. Now, where would they want to invest? My sense is the first thing they would always want to look at is quality. That's the reason why we came out with stocks which we think are of very high quality even in the mid cap space. There could be mid caps who are market leaders. There could be mid caps with product differentiation. There could be mid caps with a fabulous corporate governance. If you mix all of that, plus you put fundamentals in place, you get quite a heady number of 24, 25 stocks which one can look at. Now, when we say fundamentals, what could be those fundamentals? The first fundamental we always tell people to look at is the return on capital employed. And we put a criteria there. It has to be a consistent 15% and above over the last 5 years. And it can't be that it can be a flip-flop. It has to be a consistent 15% plus. And why would we want 15% plus? It's because the WACC for India, weighted average cost of capital, roughly translates to about 12%. So there's a 3% spread. The second one is margins. Margin variability has to be low. Increasing and variability has to be. It talks a lot of things, It says that
it sticks, the margin sticks.
Plus you have a pricing power, most important. And then whenever there is a cost escalation, you're easily able to pass it on to the company.
So what is that list looking like? I mean, what are the themes? What are the stocks?
Yeah. So the other two would be low debt. The fourth one would be free cash flows. Okay. And if you look at that list, we have come out with a list of about 24, 25. Since we don't cover most of these stocks, I'll probably give you where they actually come in.
Sure.
So some of them come in the paint space.
Okay.
Some of them come in the pharma space. We at least have 2 stocks. There, mind you, word of caution, we don't cover these stocks. We have Berger. We have, you can look at Nerolac as another. In the pharma space, it could be Abbott. It could be Sanofi. Now, these companies have fabulous fundamentals. There are a lot of stocks in the consumer discretionary space. There are a few stocks in the consumer stable space. But discretionary, you have somebody like Page, Symphony. Somebody talked about in your show about Crompton Consumer. It looks very, very good on me. So if you put that criteria, roughly about 24, 25 stocks. I can't give you all the list, but of course. The auto, again, we have some in the auto Ank space, like Vapco, for example. Endurance is another one. So that is one set of stocks we put in. The second set of stocks, we can, of course, give you a clear ideas about the stocks we cover, where we see a visibility in earnings growth, which is 15% plus in the next 2 years. And the valuations are very, very comfortable. When we say valuations are very, very comfortable, you take the current price and the current PE, vis-a-vis its 5-year average. Wherever we have seen it being significantly low, but earning visibility to be pretty strong, we have identified some stocks like that. Those stocks, of course, we can give it to you. One could be Amar Raja Battery. We have Apollo Hospitals. Then we have Crompton Consumer. We have Gujarat Gas. Then we have India Hotels. Mahindra and Mahindra Finance. We like that company very well, especially in spite of all the NBFC issues which have come in. Some stocks in the NBFC space stand out for us. One is Mahindra Financial Services. Then we have Mangalore Refinery. And then we have PNB Housing.
Okay.
So net, of course, there are questions which are being asked where, quality will persistently perform all through for many, many years to come. The answer perhaps is no. But what you will realize is, even in markets where there's a risk-on type of environment, quality mid-caps don't significantly outperform, but at least the outperformance is relatively much better than the Nifty or the index.
So I get your point, and you've enlisted the entire list of stocks that you're talking about, and they're all from the mid-cap space right now. And when you're talking about the foreign money coming to our shores, obviously, when they make an allocation, the pitch is not that I'm going to invest in the mid caps in India. The pitch is I'm going to invest in India as a market, which is expensive, which is 18, 90 times is expensive. So the case first builds up on whether or not to put money in an expensive market like India and then funnel it down to mid caps. So how do...
Okay, if you look at the markets today from the index point of view, or Nifty, or for that matter, mid cap index, we believe the markets are reasonably priced. They're not overpriced. Now, how do we do that? If you look at our proprietary frameworks, what they tell us is the attribution for long-term growth value for India is much, much lower than the long-term average. So we are about 53% for mid-caps, as against the market average of about 58%. So that gives us enough of confidence that the markets are not over-expensive. Even in the large-cap space, Nifty, for instance, the average long-term growth value for India is about 52%. We are roughly in the range of 54%. The day it goes up to 60% plus, I'll be worried. That's the time I tell investors that it's overheating market. But for now, I think the markets are reasonably good, and I think we should invest in India.
Okay, on that positive note, Ravi, so good chatting with you. Thank you so much for detailing out why mid-caps could do so well, according to your mind. Let's wait and watch if that happens. But good having you, and look forward to having you more often.
Thanks.
Give it a year's time.
Yeah, this is not short-term conversation for sure.
Don't rush it. And of course, the elections, you will still see mid-caps underperforming. But I think after elections, I think the story will really come on.
Well, let's wait and watch for that. Thanks so much for that, Ravi. Okay, quick thoughts. Our technical experts are still with us. Gentlemen, thanks so much for waiting by patiently. But just opening thoughts, 15 minutes of trade done. You guys mentioned that wait for the first 15 minutes, so we've done that. Brijesh, quick thoughts out here. Anything that stands out for you as a trade? Index or a stock?
I think one can look for buy on Hindalco. We have seen a good momentum about 210.11 after a range breakout. So at around 215, one can go long for the target of 224 with the stop loss of 210.5.
Ruchit, what about you? Quick thoughts?
I think opening on the index fund looks quite good. We had another gap up opening, and this gap could be again a continuation gap. So if this continuation gap shows its momentum, then we should head towards the all-time high or the previous October high, which was around 11,750, 11,760. So even at current levels, one can look to create fresh long positions on the index front for target around 11,750, 760.
Okay, gentlemen, leave it at that. Thanks much for taking the time out and joining us. Really appreciate your time. 0.5% up for the benchmark indices. Take a very quick break. On the other side, we talk about the government's borrowing plan with Suyash Choudhary of IDFC AMC. And then speak to Rajeev Newar of Chalet Hotels on the doors that are opening up for the industry after nearly a decade-long struggle. Back with IndianOpen right here on Bloomberg Quint. 0.5% up for the equity market, so we've started off well on the equities front. But on to other conversations. India's front-loaded its borrowing program in FY20. The aim is to raise 4.42 lakh crores from the markets by the end of September. That's a jump of more than 50% versus the last financial year. It also comes at a time when the fiscal deficit number stands at an alarming 134% of the target at the end of February, that is. So a lot riding on advanced tax collections and GST collections in March. The Indian bond yields probably started factoring in higher borrowing targets as well. Though you could argue that they have been largely flattish in the recent past, from last policy until this policy or thereabouts. Joining us now to talk about this in greater detail is Suyash Choudhary, Head of Fixed Income at IDFC AMC. Suyash, good having you. Thanks much for joining in. Well, we wanted to do this discussion 2 days on a trot. The borrowing calendar kept on getting postponed. But now finally we are there. Marginally higher than estimates, and what kind of impact on yields?
So absolutely, the government has been kind of struggling with balancing the fist for some time. It probably dates back to the last year where GST has consistently underwhelmed targets, and therefore probably there's around 50 basis point of fiscal space that has hence gotten compromised. It is reflected not just in the borrowings of the central government, but if you see the borrowings via public sector enterprises, So our sense is probably some bit of central government expenditure, which ordinarily would have borrowed through the central government, is being passed on to public sector enterprise and funded via that. So crowding out is a bit of an issue for the bond market. If you look at it another way, for the last 2 years, inflation is sub 4%. Had we spoken about this 2 years back, and had you asked me that for 2 years running inflation is going to be sub 4, I'd probably have told you that 10-year government bonds would have been at 6 or 6.5, and we are closer to 7.5 as things stand, and that's largely reflective of the significant crowding out of the fixed income market. So this is a policy issue in some sense. Another way to look at it is that the economy is getting a real interest rate shock. So inflation has fallen, but nominal yields are higher. So yes, in the micro context, the higher borrowing is a challenge. But in the macro context, this has been a challenge for some time now.
And looks like it will continue to remain a challenge. I was just looking at the repayment schedule as well. Doesn't seem like it's easing in a hurry.
And
no,
these are big numbers.
Yeah.
Yes. So yeah, you're right. I mean, going into the next few years, it does become a bit of an issue. And fundamentally, it kind of boils down to the fact that, given that globally savings are reasonably plentiful, given that we are at the end of a reasonably large quantitative easing cycle across 3 large central bankers, probably we can do a more efficient job of tapping that global savings pool. So if India has a higher ask of, let's say, infrastructure spending, there could be conduits through which, via sovereign or sovereign guarantee, some of that money can be tapped to India. Alternatively, our own households' financial savings needs to rise. But as things stand, this equilibrium is slightly less than tenable. As long as inflation is low and globally things are benign, your nominal yields are getting anchored. But like I said, on a real yield basis, India has already seen a substantial rise, which is not very optimal if you were to look at long-term opportunities for financing. And this is something that needs to be rectified, like I said.
All right, so how would you anticipate the movement of the yield curve in the first half of FY20, considering expectations of rate cuts, investor interest at the shorter end, lack of demand at the far end? How would all these variables play out? Probably could give me a range.
So if you see the shape of the yield curve has been almost continuously steepening. So far it's a bull steepening because the long end is also getting reasonably anchored owing to the factors that you mentioned, market expects a rate cut, etc. Interestingly, if you see the corporate bond curve as well, the 5x10 spread is around 60 basis points now, which is kind of higher than what we have historically seen. I mean, on the 10-year sovereign standpoint, we expect yields to remain relatively well anchored. If you were to ask for a wide range, it would probably be 7 to 740 types on the new 10-year or 7 to 7.5. It depends whether supply at some juncture starts to overwhelm us. But clearly, one other aspect of this is globally things are very soft. Major central bankers have turned dovish, chiefly the ECB and the US Fed. And we do think that locally also the growth inflation trade-off is kind of asking for further easing. And we think the new central bank governor in India has probably a more emphatic reaction function that we have seen so far. So, probably his attempt at ensuring better transmission is going to be more emphatic. And that would have some rub-offs on bond yields as well.
All right, so you mentioned supply there. And, how is the realignment of supply across various categories based on the investor interest? Obviously, the shorter dated ones, segments from the 1 to 4 year segment is seeing a bigger supply. The supply has increased 8 to 8.8%, I think, at the total of the first half of 20, from 8.3% in the first half of FY19. Will that sort of change or skew things?
Not much, because there is a natural interest at the shorter end of the curve. So people are worried about fiscal, people are worried about excess bond supply, but at the same time everyone is more confident about liquidity, as well as the fact that the repo rate is probably going to go down. Our own sense is between 50 and 75 basis more in this cycle, could be just 25 in the upcoming policy, but there's more in the pipeline. So front-end rates, there's much more anchor. Also notice this buy-sell swap that the RBI has engineered. There's been a fall in the cost of hedging up to 3 years, which has also put downward pressure on the corporate bond curve up to 3-4 years. So the sense is there is much more appetite for supply absorption here. The challenge, if at all, is at the longer end of the curve, which in the near term will not manifest.
They've also introduced new tenures at the longer end.
Yes, which is kind of normal once a year, or 1.5 times they would do that. But fundamentally, right now the market is well poised because people do expect additional easing. at some juncture probably supply begins to overwhelm. But we are also not sanguine so much about the global policy outlook, in a sense that we expect probably policy easing at some juncture to come through. Or put another way, we are not that sanguine about growth outlooks. We think growth is slowing globally. It's a synchronized slowdown. And so far that is in play. The appetite for duration here will also be well anchored.
Just to get in your point of view, while inflation is anchored at this point in time, over the next 2 years till FY21, FY22, expectations from most quarters is that inflation will start to move up, and you will have it inching back towards that bandwidth of about 4%. In light of that, front-ending your interest rate cuts, is that something that is?
So, if suppose inflation ultimately moves to 4.25, or let's say 4 and 4.5, where we are in the global business cycle, you can easily argue for incremental easing. And probably incremental easing of the order of the 50 or 75 basis over the course of the year that I mentioned. Simply because, so India never developed a real rate framework as probably it should have, because when you are inflation targeting and when that inflation variable is reasonably volatile, you probably need something that you can target better, which could be a real rate markup over where CPI is. But historically what we have seen is somewhere in the 1/4, 1/2 vicinity of real positive rate over CPI would probably be okay given where we are in the business cycle.
So yes, one final question really on this note then. What happens going ahead if what you say turns out to be true, that the Fed is a lot more dovish than what the street believes even right now, and what kind of impact does it have on the money market flows? The equity market flows are one thing, and we've seen, after a really long time, I've seen the equity market flows being a precursor of sorts. Usually in 2018 and 17, the bond markets had first started the inflows, and then equity markets were the, beneficiaries as a result of that. This time around, it's been slightly different. What happens over the course of the next 10 months to foreign flows into Indian debt?
And just to add to that, the last few months before the crisis actually started, and even during that period, the funds that flowed into the government bonds were the bigger pie, the share of the pie, bigger share of the pie. What happens if there is volatility within the bond markets for investments into?
So, the market expectation with respect to the Fed is now aligning towards easing. So if you see, where the traded futures for Fed funds are, there is easing starting to get built in. And our sense is, given where we are on the global business cycle, that's probably right. Now, one doesn't know how much inertia would happen before, such a step gets taken. And the assumption here is that there is no U-shaped kind of recovery out of what we are seeing, because it looks like a synchronized global slowdown. Now, let's assume that the path of Fed expected easing continues. It's obviously quite robust for financial flows into emerging markets, especially emerging market debt, and especially the high carry emerging markets that have largely, reasonably strong macros. And India would tick most of these boxes. There is some political risk going to the elections, but whichever dispensation comes post the election, so long as inflation targeting and fiscal consolidation remain, I don't think the bond market minds too much. Lately, we have seen stronger resumption in flow into the corporate bond market compared to the government bond market, which is also an indicator that the chase for carry is well and truly begun again, and that globally investors are much more sanguine about the backdrop, probably courtesy the dovish stance from the two major central bankers.
All right. Okay, Suyash, we'll leave it at that. Thanks so much for taking the time out and speaking with us today. Appreciate you joining us in the studios.
Thank you so much.
Well, that's the view from Suyash Choudhary. The borrowing calendar or the borrowing numbers higher, but only marginally higher. According to him, the impact on the yields in the near term also will not be that dramatic. He, of course, not too bullish on the global growth scenario. And therefore, that and the global central bank action could well have an impact on what happens to global yields and thereby the flows into different emerging market debt paper as well. But that we'll come to know as and when we come to know. Moving on to the other discussion, the Indian hotel industry is clearly slowing, but rather not slowing, but slowly moving towards moving up and to get out of the decade-long slowdown. Occupancy levels highest since 2008, and industry margins may surge to 30% from 25% at present, at least as per some reports. Chalet Hotels is one such hotel chain that's catering to the high-end and business hotels category. To help us talk about the factors for the industry at large and about growth and sustainability. Joining us right now on the show in our studios is the CFO of Chalet Hotels, Rajeev Newar. Rajeev, good afternoon. Thanks much for joining in.
Thank you. Good morning.
Good morning. The whole base expectation is that when occupancy rates industry-wide reach a particular level, at that point of time, companies do two things. One, the ability to hike ARRs in a meaningful way or room rates in a meaningful way. And two, think about expansion. We haven't had expansion per se in the last 10 years, and ARRs have only dropped in the last 10 years, save for what's happened in the last 6. How do you view the near term in light of the recent buoyancy though?
Okay, so let me answer this question in 3 parts. The first thing is that the occupancies are already in the roughly in the 70% thereabout range. If you look at our occupancy for Chalet Hotels for H1, which was almost 75%, which was H1, which was not the peak season. If you look at the last 3 years, the occupancy has only been surging ahead. So that's been very positive. And there are a couple of reasons why it's been happening. Because the demand, if you look at over the last 10, 12 years, has largely been static, in the sense that the growth has been stable. Whereas the supply has grown at a pace which was a lot faster than the growth in demand. But over the last couple of years, the demand-supply arbitrage has been favorable for the hospitality industry. So as a first part of the upcycle, what we can see, or what we have already witnessed, is that the occupancies have started moving up. And now, in the last 6 months to 1 year, we've also seen the rates moving up, so which augurs well for the industry.
Okay.
The other thing which we may keep in mind is that, we are in a brick and mortar business. To build a hotel, you cannot build it overnight. It takes a couple of years since the time you make an announcement. We are in the luxury and the upper upscale space, mostly. Now, typically from the time you make an announcement and until the time you operationalize a hotel, it's a couple of years. So if you really look at the space now, the supply is fairly muted in our segment, which used to be about 10% or more than that at one point in time, is in mid-single digits now. Now, demand remaining where it is, there's a very positive arbitrage. And if this positive arbitrage continues, it augurs well for the industry.
So how much uptake would you reckon base case scenario could come to occupancies as well as ARR? As you said, while selectively supply may be growing in 1 or 2 pockets by 1 or 2 hoteliers or larger chains, it's not really expanding across the country, right?
True, because you see, if you really look at, if you dissect this industry, the couple of companies, like a very large brand just announced recently that they want to go asset light. There are a couple of developers which had gone into the space, but are currently trying to nurse the balance sheet back to health. And I'm not sure whether they will really be going into development at the moment, which leaves a very few developers and companies to really go into the space. With the supply being muted in the near term, there is no reason to believe that the rates and the RevPAR would not creep up, other factors remaining the same. Now, coming back to the fact that if you look at the industry per se, maximum supply that is coming in today are in the mid segment and the budget segment. And we really operate at the upper upscale and the luxury segment. If you look at 2008, the rates that were prevailing in 2008 and the rates that are prevailing in 2018, we're almost 30% below in absolute terms. If you were to translate these into dollar terms, trust me, there are a lot more. The question is the propensity to pay, the customer's propensity to pay, has it gone down or gone up? I would presume it's gone up significantly. And therefore, therefore one believes that there is clearly a headroom for the customer to pay more. The second question, therefore, is when will they start paying more and how soon will we start going up? As I said, we can see green shoots already. Can't make forward-looking statements, but the macroeconomic indicators suggest that other things remaining equal or same, one expects that we are up in for a longish upcycle now.
All right. Just one point there that I want to make, and I've been gathering from the reports that while the hospitality industry is coming out of this 10-year lull at such a point in time when there is a chance of an upscale, it's always better to back asset owners rather than brand owners themselves. I mean, and for you particularly, there is a likelihood of the gain of EBITDA market share, EBITDA pie is going to be that much more higher. How well positioned are you as a asset owner rather than just a brand owner?
I think I completely endorse your point of view, because you see, at the end of the day, the P&L belongs to the asset owner, and you pay a certain fee to the brand. So in an upcycle or in an upcycle, typically what happens is a large share of the pie typically goes to the asset owner. So from that perspective, I completely endorse your view.
So what would the EBITDA share be? As in, what would the growth number be like from?
Growth numbers be
for EBITDA, the amount of.
So you see, different companies have a different EBITDA. In our case, our EBITDAs last year for the segment was roughly around 38%.
Yeah.
Now
from the hospitality side.
For the hospitality segment. We have a couple of other segments, but they're small at the moment.
And the industry is 20-25%. So that's anyway a big premium.
If I go by the public listed companies, they have reported EBITDA close to that.
Yeah.
So if you look at from that perspective, firstly, the asset owners stand to gain more in an upcycle. The second thing, if your margins are healthier, then you tend to gain a little more from that perspective.
Can the number increase, 38%?
I'm an optimistic person, and I always believe the numbers can improve, but I like to look at this a little logically. If you were to go back to the years of 2007-8 and thereabouts, during those days, the EBITDA was a lot higher. The percentage was a lot higher. The second logical point is that, this business, if you look at the cost structure, it's largely a fixed cost structure. The variable cost is marginal. And therefore, at a stage where the rates kind of start growing, the flow through in this industry generally world over are seen to improve at a faster pace than the increase in the rate. So if the rate grows at X, usually it is seen that the EBITDA tends to grow at a much faster pace, subject to occupancies also continuing to grow in a healthy way. And more importantly, if you look at the occupancy levels today, for our portfolio, it was 75% in H1. Across the industry, they're more or less in the 70s or thereabouts. One of our hotels at New Bombay has been consistently clocking an occupancy for the last many months of over 85%. And we believe that 85% is a sustainable occupancy level.
For your entire portfolio? No. For the new
For the portfolio, depends on the supply, demand-supply equations. We have seen that in the past. The question is it sustainable? The answer is yes. We therefore believe that there is a potential headroom in occupancy, and there's a potential headroom in rates. How and when is this going to get materialized? I would hesitate to say that, because I don't want to give forward-looking statements. Having said that, I can only say that if you're looking at the macroeconomic indicators and the early signs that we have received in the last 12 months, they seem to augur well for the industry. You pick up the industry reports, you pick up the research reports, they're all very optimistic, and there's a lot of enthusiasm in there.
Well, okay. Let's hope that it does shape out that way and even better than that, Rajeev. We wish you all the best. I know you can't talk specific numbers, but we'll talk to you post your quarterly numbers coming out as well.
Thank you.
Thank you.
But thanks so much for taking the time out and being with us today. Well, just about done. Quick moment to look at what's happened in the markets. Trading in or around the highest point of the day for the Sensex, 287 odd points, 0.5% for the Nifty Bank as well. So the going is good. Let's see if this lasts. Wrap on this leg of Indian Open though, from Devina and me and the team that put this show together. Thanks so much for watching. Up next is the F1 show, and we talk about the Embassy IPO as it lists today.